That is a gorgeous view. Okay, so here's why I'm making this video today. Usually during my lunch hour, I go on these hour-long walks. When I use that time poorly, I'm stuck on some conference call with 20 other people. When I use it really well, I'm connecting one-on-one with my direct reports and my team members. I'm reflecting on what needs to happen, getting into the details of the world. So today is special because I've never done this. I'm going to use this hour in this video to teach you about banking, specifically custody banking. If I get it right, today's walk should be useful for three audiences. If you're joining a custody bank, like the Bank of New York, JP Morgan, Northern Trust, State Street, as a new employee, it's good to know the role they play in the financial markets, and I mean in great detail. Second group that should be watching this are my engineers. If you're an engineer at a custody bank, or anywhere really, why should you watch this? Because your path to becoming a CIO isn't simply about increasing your engineering knowledge. Your path to the C-suite is entirely based on how deeply you understand the business that you support, the full business, end to end. Third group that should be watching this, well, if you're an entrepreneur or an intrapreneur, you'll want to understand intimately the space you need to disrupt. And trust me, custody banking needs serious disruption. So, it's a gorgeous day outside. Let's get to it. Let's first talk about what custody means and why we need custodians in the financial markets. Towards the middle of this walk, where there's another great view, by the way, we'll go into some detail about the products and services within custody. And sprinkled throughout the walk, we will discuss how other asset servicing products intersect with custody and even build on custody's core offering. So let's define some terms, get this started. I'm going to be using the term security throughout this walk. Let's talk a minute about what a security is. It's a tradable financial instrument that can take many forms right now. This might be a roundabout way of explaining the word security, but there is a lot of talk in the world about tokenization. What is tokenization? There are many assets that I personally would love to own, but could never afford. Here's a crazy example. I'm a big fan of Picasso's artwork. I could never afford to buy his Women of Algiers painting, but boy, would I love to own a tiny little piece. The Women of Algiers was sold back in 2015 for what was, I think, about $179 million. It was sold by an owner who paid just under $32 million for it. And that was back in 1997. If you do the math, it's 18 years. It appreciated $147 million, which works out to be about 10% growth per year. That's a solid return. If that painting were tokenized, going back to why when we went into this, or split into 1,000 pieces, you could own 0.1% of it for just shy of about $150,000. You'd benefit as the art appreciates in value or share in the risk of it if it gets stolen. But tokenization would allow you to say that you own Picasso. Not a Picasso, but Picasso, like it's a stock. Anything can be tokenized. A building, like Frank Gehry's Guggenheim. A sports team, like the New York Jets, although I don't see why you would want to own a piece of that. A movie, like Avengers Infinity War. A musical act, like Lady Gaga. In all those cases, you'd be buying a small portion of the future revenue of, or future, appreciation of that thing or service. So tokenization is what companies do when they sell stocks. They're raising capital by selling pieces of their company into small, digestible chunks that anyone can buy and sell. This is similar to what a town might do when it doesn't have millions of dollars to build a new high school, right? The town would sell what are called municipal bonds to raise that capital. A bond is a little bit different than a stock, though. In exchange for your investment in a bond, you don't actually own a part of the high school. Instead, you're promised steady income in the form of a dividend. A dividend is like an interest payment. Stocks and bonds are just two types of securities, which is where we started. So a security is defined as a tradable financial instrument. Like anything that has value, this is where custody comes in, securities need to be protected. You need to have a way to buy and sell them, a way that you can trust, and you need a place to store them and know with confidence that they are safe. So liquidity and safety are what owners of securities need. Enter custody banking. That's what custody means. Custody is the safekeeping of a client's assets. What does it mean to keep a client's assets safe? To explain this in a way that will eventually make some sense, humor me, and let's jump into a time machine and travel back to the 20th century for a little bit of history. It used to be that securities, stocks and bonds, were little pieces of paper. Not like this, like pieces of paper. When you bought stock, you would get a stock certificate, oftentimes with like an embossed seal, colorful watermarks, fancy fonts, but paper, like money. Each piece of paper was denominated into a value. Each bond, for instance, showed its dollar amount, just like money. Each stock certificate, let me make sure I don't get hit by a car. Each stock certificate showed the number of shares in a company that piece of paper represented. So when I get back to the house, I'll edit in a picture of one. On the back of the stock certificate, there would be a handwritten ledger. The ledger showed past owners of that security, and at the bottom, the current owner of the certificate. Very much like library books back in the day in high school. The back of them, right? Remember where you signed your name and you saw everyone who checked out that book before? So, securities are tradable, but unlike cash, possession of a stock certificate is not the same as the ownership of that stock. Registering ownership had real financial implications when it wasn't done properly. So securities were stored back in the day in gigantic vaults, and custodians were in the business of protecting these paper-based securities. Custodians were safeguards against theft, water, fire damage. When you bought a stock, the ledger on the back of this certificate would be updated, and the security would be mailed or delivered to the new owner, or more often, the owner's broker, and again, stored back in that giant vault. And just like storing and moving physical cash around these days is inefficient, the process back then begged for disruption. So just as payments have become digitized with credit cards, wire transfers, mobile payments, cryptocurrencies, securities too were digitized. The process where physical paper securities are turned into electronic or digital form is called dematerialization. Tough word, you don't need to remember it. But dematerialization was introduced in the 1960s, and in the 80s and 90s, almost all securities were fully digitized. Dematerialization led to the formation of what we call depositories. Formerly, they're called CSDs, which stands for Central Securities Depositories. They are the bookkeepers of all securities in a particular geography. In the US, for example, there are 2 depositories. I actually worked at one for a year, the DTCC, the Depository Trust and Clearing Corporation. They hold all public stocks and some bonds. The other depository in the US, by the way, is the Fed, which you've all heard about on the news, given all the talk about inflation. The Fed also acts as a depository, but for government debt. Like the example we talked about before when the town wanted to build a high school. Now, this would be the federal government raising funds to finance large programs, like a major infrastructure build out. So the DTCC and the Fed are the two US depositories. In Europe, they have Clearstream and Euroclear. In Japan, there's something called the JASDEC. In India, there's the NSDL, which is the National Securities Depository, and the CDSL, the Central Securities Depository. So a good next question to ask would be, how does a depository like the DTCC keep track of all the US-based securities on its books? Aren't there like millions, if not billions, of shareholders with securities changing hands every second of every day? Yeah, there are. So the way the depository handles this is by distributing its record keeping. The depository only holds accounts for what are called participants. These are very large financial entities like major banks and broker-dealers. Like each large custodian in the US is a participant at DTCC, meaning that they have an account at the DTCC and all of that custodian's clients do business through their custodian, meaning that mainstream clients never transact directly with a depository like the DTCC. So it's kind of like a pyramid structure, not a pyramid scheme, a structure where investors have stocks and cash accounts with participants, and participants have accounts with depositories. And that is what we call the federated model. Here's an example. Let's say there's a company called Custody Corp that does nothing but custody, fictitious custody bank. Let's say they have 3 clients that each holds 5 million shares of Apple common stock. Each client holds 5 million shares in their segregated accounts, but you won't find those shares in the name of those clients at the DTCC. DTCC will show that Custody Corp is the legal owner of all 15 million shares, 3 sets of 5 of Apple stock. The kind of account that Custody Corp has at the depository is called an Omnibus account. Here's where you get into the details. And you know, details are important. So, what is the depository doing with those Omnibus accounts? When stocks are bought and sold, they're treated like transfers from one Omnibus account to another. If one of Custody Corp's clients sells Apple stock to another custodian's client at the depository, at the DTCC, there would be a book transfer from Custody Corp's Omnibus account to the other custodian's accounts. And in Custody Corp's ledger, the client's Apple position would be reduced by the number of shares sold, and the cash position would be increased by whatever the proceeds were from that sale. Custodians provide a large number of services to clients. There are 3 core custody services: settlement, safekeeping, and cash management. One role of the custodian is to facilitate the settlement of transactions on behalf of its clients. When an investor buys or sells a stock or bond or any kind of security, they need to settle up with the other party. Make sure that the details match. One party is getting stock, the other is getting cash from the sale of that stock. So one of the services that a custodian typically offers is the ability to settle trades of different types of securities in different markets around the world. Let's go back to the example we talked about, where there were 3 clients who held Apple common stock shares. The depository would store the aggregate of these clients' holdings under Custody Corp's Omnibus account. We already mentioned that Custody Corp in turn is responsible for the safekeeping safekeeping of each of these clients' holdings. So in this example, Custody Corp's internal books and record systems would track the breakout of those Apple shares by client, and it's not just for stocks, right? Custody Corp would be responsible for safekeeping of all that of the client's positions and the securities they own across different asset classes and in different jurisdictions around the world. Jurisdiction, that's important. Now's a good time to mention one caveat about depositories. I talked about Omnibus accounts, where Custody Corp is the entity on record with the depository, the legal owner of its clients' positions. There are some countries or jurisdictions that require end beneficiaries or owners to be recorded in the local jurisdiction. In those cases, a Custody Corp Omnibus account can't be used at the local depository. Instead, segregated accounts would need to be opened for each of the Custody Corp clients. This is just something to be aware of. Most depositories, they do allow for the use of omnibus accounts, but it's a good thing to note in the back of your head, right? The important point is to understand that all client positions, regardless of whether securities are held in omnibus accounts or segregated accounts, regardless of which depository they're held in, are accounted for in the software systems of Custody Corp. So the third core service that a custodian provides for clients is managing their cash. When a client buys a security, they need to pay cash, and to offset the risk of settlement, usually the transfer of cash and security happens at the same time. As securities come in, cash needs to go out, so custodians manage cash on behalf of clients for their buy and sell transactions, which means they maintain a cash balance with the custodian. Custodians typically offer a number of services to manage excess cash, and there are other services outside of the core custody functions that might extend credit to clients based on like trading activity or the kinds of trades they engage in. Similarly, on the securities side, a custodian might have a securities lending service, which is exactly what it sounds like. They lend securities. I'm only mentioning these services to make a point that a core custody business is the backbone that supports a large number of value-added services for clients, like collateral management, securities lending, liquidity management. Each one of these deserves its own little hour-long walk. Custodians typically have very large financial institutions as their clients, B2B, and these clients tend to do business globally. We mentioned this during the jurisdiction thing I said, not 20 yards ago. So a custodian as a participant might hold direct accounts in the depository in certain geographies. However, to service any client who may want to do business in a different geography, a custodian would need to determine whether it makes economic sense to open accounts in that country's depository or to outsource it, and instead leverage the services of a local custodian in that market who would already have accounts in that country's depository. These subcontracted or outsourced entities are called subcustodians. They are operating on behalf of the custodian in a given country or jurisdiction. So let's say Custody Corp is the custodian for client ABC, and client ABC really wants to trade in Jakarta. Would it make sense for Custody Corp to set up an office in Indonesia? Maybe, it might, if Custody Corp has a lot of clients who want to do business there. But if that's not the case, or if the economics don't make sense for Custody Corp to open its own facility, the company would enter into an agreement with a local Indonesian subcustodian, which would provide those products and services locally. However, and this is important, Just because Custody Corp owns the outsourcing agreement with that Indonesian subcustodian or any subcustodian, the full responsibility to Custody Corp's clients resides solely with Custody Corp. From the client's perspective, Custody Corp is its custodian, and the buck stops with Custody Corp, not the subcustodian. So Custody Corp needs to make sure that when it selects the subcustodian, it has very clear arrangements to cover things like how instructions will be sent and handled between Custody Corp clients and Jakarta, and how the custodian will capture and store copies of those instructions and activity happening in Jakarta for things like auditability, reconciliation, reporting purposes. Details like this are critical to ensure that at the end of the day, Custody Corp has, clients who know they have one phone number to call anytime they need help. So, a custodian might have a network of subcustodians around the world handling securities and activities locally, but again, from a client's perspective, Custody Corp is where the buck stops. Just like what custodians do for securities, they could similarly have arrangements on the cash side as well. Remember, cash management was a big thing. A custodian might have a banking presence for cash in certain geographies, but not in others. And in that case, there could be an arrangement made with a local bank where Custody Corp would maintain an account. This kind of account is called a nostro. It's an industry-specific term, nostro. When clients want to move from, say, US dollars to Thai baht, Custody Corp doesn't have to have a local presence in Bangkok. Instructions can be sent to its nostro agent, that bank in Bangkok, to say, debit our account in Bangkok and pay whoever we need to pay, maybe an exchange, maybe a depository, or another party. And that is how Custody Corp's clients have their transactions executed seamlessly, even though neither the client nor Custody Corp has local presence in that country. These kinds of relationships, subcustodians and nostro agents, allow custodians to operate around the world without having to set up offices and keep staff in every country where clients want to conduct business. Securities are never static. Prices are constantly changing. Positions are constantly changing. Custodians have a unique view into their clients' positions all around the world on a near real-time basis, right? So let's recap what we've talked about so far on the walk. We talked about what it means to be a custodian. You are an intermediary between clients and depositories. And for the entrepreneurs listening, what happens to all intermediaries eventually? I think we talked about what kinds of services typically are offered by custodians: safekeeping, settlement, cash management. We talked about how operating globally requires close coordination, tracking, and reporting for clients. That was our talk about nostros and subcustodians. And given where we are in our hour-long walk, it looks like we should jump into the world of corporate actions. Corporate actions, it's important to understand them. So let's do this. We can cover what corporate actions are, very high level, what the different types of corporate actions are, who is involved in a corporate action, what some key dates are for the corporate action, how communications take place, and how a custody bank handles each kind of corporate action. So let's assume someone bought a security, which we defined earlier as one of many different types of stocks or bonds or tokenized assets. Once that security is cleared and settled, the process we talked about earlier, the owner then becomes what's called the beneficial owner, not an industry-specific term, of that security. which means that the owner accrues all benefits that the issuer of the security wants to share with them. When the issuer of the security institutes an action, all holders of that security potentially benefit. Because actions taken by the issuer and this is a good little side thing, they're not always beneficial to owners, so it's safe to assume that most of the time they're intended to be beneficial, right? So corporate actions have different flavors. For example, an issuer like Apple or IBM might declare a dividend, say 5%. The beneficial owners would receive that dividend payment in cash or stock. Other examples would be a company could want to change its name. That's simple. Or the issuer could announce a stock split where the company might determine that a stock is traded at too high a price and therefore cannot be afforded by many different types of investors. Therefore, they would split each share of stock into multiple shares and adjust the share price down to make the per unit cost attractive to all investors. The company might want to merge with another company. Another example where would be like a company would want to spin off one of its businesses into a completely separate and independent company. These are just examples of corporate actions we see regularly. Before I go into the 3 different types of corporate actions, I should probably show you my view, because this is the reason I walk every day to this park. That is New York City in all its glory, and it's beautiful. Okay, there are 3 different types of corporate actions. Some corporate actions are mandatory, which means that as a beneficial owner, you don't have a choice. Whatever the issuer decides, you are stuck with that outcome, right? Second type is called voluntary, which means that you as the beneficial owner can either participate or choose to ignore it. Third type is called mandatory with an option. For example, a company declares a 3% dividend and gives each investor the option to receive that dividend in the form of either cash or additional company stock. Until now, we've covered what a corporate action is and what the different types of corporate actions are. So let's talk about why. So, some common ones, or in what cases corporate actions are done. The issuer of a security wants to share its profits, right, with its shareholders. The excess income over expenses that they have realized over a certain period, in a quarter, in a year, year end, they want to share that with their investors. They would issue a corporate action. Another example might be corporate payments on debt are more defined corporate actions, but they are more than income processing because you're buying a bond. The terms of the payment schedule are already laid out in a prospectus. Interest is determined to be paid out monthly, quarterly, biannually, you get it. Companies may undertake a corporate action in order to change a capital structure. It's a little complex, but it basically means they want to either have more debt and less equity or more equity and less debt. The company could issue a corporate action announcing that it'll be converting such and such debt into stock, for example. Another one is company's goal might be to influence the stock price in the market by declaring a higher dividend. We see that happening a lot in inflationary times like ours. The thought is that the income stream makes the equity attractive to other investors, which would raise its stock price. Not that this is a guaranteed outcome, it's just potential intent. There are some other reasons why companies issue a corporate action. Now let's talk about who is involved in a corporate action. First, we talked about this group a bunch already in this walk, is the issuer. So the issuer is the body that actually announces, the corporate action. It could be a company, a local government, a sovereign nation, any legal entity. Next, there are the registrar and the transfer agent. These are institutions that are hired by an issuer to keep track of who is holding that issuer's securities. There are banks who act as custodians, and there are subcustodians who, as we discussed, are regional players. And the most important, who part of this whole equation, are the actual investors themselves, right? So it's a good note here. It's a good time to note that data vendors also play a pretty critical role in corporate actions, right? They specialize in collecting corporate action information from different issuers, creating data files that they share with, really sell to custodians and other interested parties. But that's the ecosystem. Now that we know the why and the who, let's talk about the when. Corporate action doesn't happen in one single instance of time. The only thing that happens in an instant of time is the issuance, what's called the announcement of the corporate action. After the announcement, there are critical dates that come into play up until that final settlement takes place. And it could take days, weeks, even months for the disposition or the execution of that corporate action. So let's take a few minutes to talk about some of these dates, because details matter. Can't say that enough. Let's say we'll pick Apple again. We've talked about Apple the entire time. Let's say they're announcing a dividend on their stock. Apple stock changes hands every day through normal buying and selling. There has to be a line in the sand that identifies who those dividends are paid to, the buyer or the seller. There are two dates that determine this, right? The first is called the record date. The record date set by the issuer refers to the date by which you registered as official holders of the security in order to be entitled to the corporate action. In this example, to receive a dividend payment from Apple, right? The second is what's called the X date. The X date is the trade date on or after which the benefits of the corporate action are not conveyed to the new buyer of the security. It's usually a day or two before the record date, right? So dates to be aware of. The other dates, the response date. Response dates come into play when there is a corporate action that requires the user to do something. For example, if the board of directors of a company calls for a shareholder vote, this is the deadline by which votes must be received. Another date is the payment date. So that one's pretty obvious. It's as the name suggests, the date on which dividends or interest are paid out to the holder of that security. Those are the four dates you need to remember. If the date is missed, if something is not processed correctly, dire consequences. Essentially, corporate action is not considered legal by the issuer if anything goes wrong. So you got to treat it with care, urgency, thoughtfulness. Now, we have, I'd say, a hang of what corporate actions are. Who's involved? We talked about that. What are the key dates? We talked about that. Let's go into the next level of detail in terms of what the typical process is. Let's break this process into parts. As we already covered, in the first part of this walk, the announcement of the corporate action is done by the issuer. Given that the nature of the markets for shareholders are different from place to place, like Tokyo, or versus London versus New York, the issuer might be in any one of those. They might not speak the same language. So when announcements become critical in terms of how they're captured and distributed to all shareholders, there's complexity. Multiple parties, multiple languages, multiple jurisdictions are going to be involved, and the issuer and the securities holder need that simplified. This is where data vendors, custodians, asset managers play that communication role, that simplification role. Jumping back to our example where Apple declared like a 5% dividend, the 5% dividend doesn't tell us what that equals in dollars, right? Is that $5 million, $500, 50 cents? Point is that someone needs to compute how much of that security a shareholder owns, and then do some math to, convert that corporate action into a dollar amount or a yen amount or, some currency. In the industry, we call that process entitlement. That's a key industry term, entitlement. It's a process, only rich white men can relate to. All right, humor. Once entitlement is done, a custodian or subcustodian will communicate to each holder of the security, letting them know what the corporate action was and the impact of that entitlement. In the industry, that notification is called, drumroll, notification. Again, an industry-specific term. There are other cases where the corporate action asks shareholders to reply back to a certain deadline. An example would be with like voting rights. A voting right is a right of a shareholder to vote on matters of corporate policy. There could be a vote on who should belong to the board of directors, or whether the company should issue new securities, or even on changes to the way the company operates. Each shareholder selects from different options that they're offered, or they may choose not to respond at all. In any event, all these responses need to be collected and tabulated. If the corporate action is voluntary, it's a very important word, meaning that there is an option to respond with a choice. The security owner would send a response, another important word, industry specific, back to the custodian. So obviously, if the corporate action falls into the mandatory category, this whole step is skipped. Once all responses are processed, instructions, again a key word, need to be sent out to custodians, subcustodians, and the issuer in terms of what the results were and how the corporate action needs to be processed. Last but not least, shareholder is going to need to get paid. So we've talked about the multiple roles involved in a corporate action, from the fact that they can be distributed across the globe. How does all of that data move back and forth? How do announcements arrive? How do we distribute them? How do we collect responses? It can be done in lots of ways. Back in the day, companies used to use faxes for it. Sadly, many still do. Most of it, though, is done through an electronic messaging platform called SWIFT. It's the SWIFT network. It was in the news because of the whole Russia war thing. SWIFT is a global network that connects about 10,000 different banks around the world. It's useful because it also enforces certain standards of communication. SWIFT has defined formats for a number of message types, among them standards for different types of corporate action messages. If I was losing you with jargon before, get ready for the bottomless pit of jargon, but it's worth knowing, right? I'm talking about Swift codes or MTs or message types. Every step in the process I described has a message type. There is what's called an MT 564, which is the notification message. There's something called an MT 565, which is an instruction message. It can be sent from an account holder to a servicer or a custodian who processes it. There's a 556. That's a confirmation saying, yep, we received your transmission. We're going to process it and do X, Y, Z with it. There's a 567. They all have MT before it, so MT 567. That is a status message, like, here's the status of a corporate action. Here is the instruction we received. There's a 568. That's a narrative, like a blob message that gives details in some, in terms of like what's been done to a particular corporate action. I could go on with Swift messaging, but my guess is you're all already fast asleep. So, let's move on. To be clear, it's not always or even usually the case that a corporate action generates a message sent to an investor, right? It's much more common that many messages are sent back and forth from party to party just for one corporate action. Why? Because nothing ever stops in the securities industry, right? Securities are traded every minute of every day, practically. X dates and record dates need to be tracked for each security where there is an announced corporate action, and securities are changing hands often many times every day as they're being bought and sold. This requires constant messaging to ensure that a corporate, like a custodian, has the right inputs to process the corporate action correctly. What kind of tech supports corporate action processing within a custody bank? A lot. So let's quickly define a few terms. The first is the system of record. A system of record is a golden source of different kinds of data within an enterprise. The second term we want to probably define is a security master. This is a system of record for all securities and instruments that a custodian interacts with. The data is sourced from different vendors like Bloomberg or ICE, and that data is constantly scrubbed and normalized. We also catalog corporate events in a security master or in the security master ecosystem to retain a history. So if we wanted to see all corporate actions from Apple or IBM for the past 3 months, we can query that system and come up with the list. Because keep in mind, Apple may not comprise of just one security, right? Apple common stock, which is what most people think of when they think of Apple. It may cover many different types of securities or instruments issued by Apple. Calculating entitlements requires data from systems of record, a security master, and several industry data providers. We also utilize third-party platforms to send out announcements and notifications, gather responses back, to process and send messages out. We use different systems with our subcustodians. And all of these systems traffic mainly in Swift messages. But as I painfully pointed out before, there's still quite a large number of folks who use faxes still, which is horrendous in 2022. There are a host of servicing systems that calculate entitlements, and because there are many inputs, custodians do exhaustive reconciliation to ensure that no errors have been made. The need for constant notification across the industry, and this is speaking to all you entrepreneurs, the need for constant reconciliation across the industry is the best evidence yet that blockchain and decentralized finance have yet to disrupt this sector. Once entitlements are computed and reconciled, different systems at every custodian execute payments. So that's yet another space aching for disruption. To recap, so we've covered some of the who, the what, the when, the why of corporate actions. Let's dive into an example, I guess, because I still have about 20 minutes left to my walk, maybe 15. Let's talk through one type of corporate action. Let's say a cash dividend, all right? What are the steps that a custodian takes when an issuer wants to provide a dividend? Let's say that IBM has declared a cash dividend of $1.62 on their common stock, meaning that if you hold one share of IBM, you're getting $1.62. I want to make up some dates here just so that we can flesh out the details. The critical dates for this dividend are its X date, let's say February 7th, and its record date, let's say February 10th, 3 days later, and its payment date, March 10th, so like a month out. This means, what does it mean? It means, one, purchases of the stock on February 7th or later are not eligible to benefit from the corporate action. In other words, stock has to change hands on February 7th or later, right? For its seller to benefit versus the new buyer to be entitled to a dividend. Number two, all stock holdings on record as of February 10th are entitled to the dividend. And three, the dividend will be paid out a month later, March 10th, I think I said. So the corporate action announcement could be transmitted from a data provider like a Bloomberg or an IDC, or we might get it from a central securities depository or a subcustodian. Key point here is that corporate action announcements come from lots of different sources, right? Once they're received, that corporate action is checked for validity and to make sure that key pieces of information are captured, like the dates I just mentioned, right? The X date, the record date, the payment date, the unique identifier of the security. Once validated, the corporate action is stored in a custodian's security master, like I mentioned before, or the security master ecosystem. And that really is about how do you validate and store corporate action information. So in this example, let's say that the corporate action was received on January 29th. On January 30th, for this, a notification would be sent out to all the customers of the custodian. All of the asset managers would be notified that, well, if they hold IBM stock in this case. I use a qualifier IBM stock because IBM may have issued more than one security. Again, that could be preferred shares, warrants, other types of securities issued in addition to just common stock or bonds. So only those holders of the security identifier stipulated in the corporate action are entitled to receive the dividend. Each security has a unique ISIN or CUSIP. ISIN is spelled ISIN. CUSIP is spelled CUSIP. Part of the validation to make sure that the custodian is acting on the right security is getting the ISIN and the CUSIPs right. Preliminary notification would be sent out using a Swift message, type MT564. Do we know our numbers or what? And all clients who hold that security would get one of those messages. And for those not on Swift, they would get a wonderful email or fax. The second step, we talked about this earlier, is entitlement. So entitlement is the process of calculating who would receive what dividend amounts. The system of record that maintains client positions would give us all of the numbers and facts that we need to calculate the entitlements based on the number of shares held by that entity. Again, only holders of the specific security identifiers would be eligible on or around January 31st in the pretend timeline that we just pulled out. A detailed notification would be sent out to all of those clients. The detailed notification includes a listing of the client's holdings in the security at that point in time, along with its dividend entitlements in exact dollar value. On or around February 7th, the X date, again, a detailed notification on the cash dividend corporate action would be sent out to all clients who hold that as of February 6th. Let's make sure I don't get hit by a car. Those dates are critical, I think, because a lot of the custodian's clients will be getting into and out of securities over and over again, some buying, some selling. So from the custodian's perspective, they just need to make sure that by that date, one, they have a correct list of holders of that security and what amounts. Two, what they would need to know the entitlements that have been calculated. And three, they would need to send out detailed notifications. On or about February 11th, a detailed notification is again sent out with the cash dividend corporate action entitlement to all clients who hold stock as of February 10th, the record date. On the 3rd of March, advice is sent to all clients who hold or held the security as of the record date. Payments would be posted to their accounts, on March 10th. They are sent advanced notice so they know what to expect, and this is sent through another Swift message, an MT567. Those not on the Swift network get the joy of an email or a fax. On or about March 10th, no, it's usually on that exact date, March 10th, custodians credit the accounts of security holders with the amounts they are entitled as per the cash dividend corporate action. So, you may wonder, where did the custodian get the money in order to pay all of its clients? This $1.68 times millions and millions, right? So the bank, if it's going to pay out $1.62 million out of pocket, it's going to have an issue. So the custodian needs to receive the cash. The answer is obviously that the custodian gets its cash from the issuer, in this case, IBM. Part of the job of a custodian is to take bulk payment from an issuer and make sure that is distributed in a pro rata basis on the number of shares held. Sometimes, and you can tell I'm towards the end of my walk because I'm a little winded, sometimes there's a timing difference between when funds are received from the issuer and when they're paid to client accounts. When all is said and done, though, reconciliations are performed. There are controls, lots of controls in place to make sure that the issuer is not paying out more than it needs to, that the custodian is not paying out more than it needs to, and that all of the investors are getting the exact right amount for that cash dividend. Some clients may have a standing instruction. That standing instruction might say something like what currency they want it in. You know, if the IBM dividend was denominated in US dollars in this example, a client may want to be paid in Swiss francs or Japanese yen or euros. And that is everything you need to know about an example of a corporate action, cash dividend. So, tax. I said I'd mention tax, and I got 5 minutes to do tax. So let's talk about tax. Some clients of the custodian might be located in different domiciles, right? Meaning that there is a potential that the payments have tax implications depending on the jurisdiction of the client. Some jurisdictions may impose like a withholding tax, some a consumption tax. Well, whatever the tax is, it has to be computed, and tax forms need to be issued by the custodian. In the case of the US, we have 1099s. Those need to be issued. Whatever the equivalent documents are in the jurisdiction or jurisdictions for the investor, that needs to be done by the custody bank. Another consideration is that certain entities might be tax exempt. Certain pension funds, for example. The client would have to submit documentation proving tax exemption, and the custodian, which is part of its standard process, would deduct appropriate taxes, can help in the submission of tax refunds or what are called reclaims, right? So tax processing is a pretty integral part of the whole process, as are foreign currency conversions, FX. The important point here is that corporate action processing doesn't end with calculating the entitlement. The reality is that that's just the beginning, right? The entire settlement process of a corporate action, in the case of a dividend, includes, like, just to sum it up, how the dividend is paid out. Can US dollars be used, or foreign currencies? How will you compute the tax and its tax impacts? And then facilitating any reclaims or refunds, on taxes paid. All are integral to corporate action processing. I guess that actually raises two other points of concern and I'm coming up to my house. Number one, does the custodian have all the domicile and tax documentation on hand? And two, assuming that they do, data and documentation might have to be fetched from different systems within a custody bank. Some may be collected through like a client onboarding system, some might live in a central database, some might be in a separate tax processing system. There is some complexity there. So broadly, that is how a cash dividend is processed. All right, thanks for joining. Have a good day.